To our local market now, and European and US investors were feeling the pain from Spain's spiralling debt crisis, but better news out of China was a ray of hope here. I spoke to Marcus Padley from Patersons Securities a little earlier. Well, Marcus Padley, a horrendous day in Europe yesterday, but the Australian market crept into positive territory. Now, how important was the latest read of Chinese manufacturing?
Well, it bounced the market about 15 points. We were down 15. We went back to nothing. I think we closed slightly up. But it was a very low volume day. We did most of the damage yesterday when our market fell 70 points. Volume today was 3.1 billion, where the average is over 4 billion, and in the bull market somewhere around 7 billion. The damage has been done in resources recently. Since the market peaked in April, resources sector's down 8%. And over that period, something like telecom sector is up 14%, and industrials are up about 3 or 4%. So it's all resources at the moment.
I think quite a rocky ride for some of the mid-tier iron ore producers. Fortescue Metals and Atlas Iron were touching some multi-year lows, weren't they?
Yes, iron ore stocks, of course, but also, BHP's on a 4-year low at the moment. And all this is to do with the iron ore price, which has gone down 9 days on the trot. And this Access Economics report out yesterday talking about the horizon on the resources sector, basically saying what we all know to be true but no one's ever voiced, which is at some point the resources boom ends, and as we start to envision the end, we start to realise that maybe valuations on a lot of resources stocks are not factoring in non-boom commodity prices but are using current commodity price, in which case they are too high.
You don't think that the end of this boom is being called a little early?
No, but I've always felt that commodity price forecasts in a lot of broker valuations are still too high because the valuations are so much above the current share prices and are basically telling you to buy stocks that have gone down, and they've done that for a year and the stocks are down 30%. So I think the valuations are being wrong based on boom time assumptions, and the Access Economics is telling us that that is wrong.
All right, well, let's go to finance. Macquarie Group has its AGM tomorrow. What are you expecting there?
Well, they are one of the most exposed stocks to the trends in the market, which obviously aren't good trends at the moment. But they had results back in April and actually sort of beat expectations, so they manage expectations fairly well. But this is an opportunity for them to update the market. The risks are on the downside. We've seen 40 profit warnings running into this results season from ASX 200 companies so far. It could be potentially another one. Either way, unlikely to surprise on the upside.
And finally, what do you make of this reported new competition for the ASX? The London-based LCH ClearNet hoping to operate clearing functions for derivatives, cash and equities in Australia.
Well, the ASX share price wasn't too fussed by it. They obviously are a monopolist on the market, and a challenge to their monopoly is threatening to value, and they certainly suffered when Chi-X came into the market. This doesn't seem to have worried anyone too much yet, but we'll see how it develops.
Marcus Padley, thank you very much for joining us.
My pleasure, Tiki.